Welcome to Subramani. When Warren Buffett calls somebody a good investor or a great investor, it is worth looking up that person and seeing what that person has done. And that set me on research on a person called Walter Schloss. Walterschloss. Sounds like very much like a German name. But yeah, this is the person, and so we must look at him. He is 90 plus, and he began in 1916, so he's almost there, right? I have no clue whether he's still alive. I did some research on him, and I got some stuff on him this was some time back, and I do not know whether he's still alive, so I'm not getting into that. I didn't do that research. He was born in 1916 and entered the market at the age of 18, and he obviously at the age of 18 must have been 1934, and 1934 meant the market was still in a shock of the depression. It was perhaps recovering, but not really. It was definitely not a booming market, nor was it a market which was about to fall. So there he was, and he was a student of Graham. So he joined Graham. He met Buffett there, and first let's look at his track record. His fund achieved an average compounded growth of 15.5% till he closed it in the year 2000, which means he must have been 84 years of age. He was managing the fund till he was 84 years of age. Step 1, longevity of life. Taking care of your health is very important for good big investing. During this period, the S&P 500 returned about 10%, and he returned about, I think, 15.5%, right? So that does not explain to you the impact, right? 10 and 15 over a long period of time shows you that if you had invested $10,000 with him in 1955 when he started the fund, then by 2000 it would have become 729,000 in S&P. And how much would it have become if you had invested in his fund? His 10,000 would have become 53,88,000, almost 54 lakhs. So where is 7 lakhs and where is 54 lakhs? That is what is called alpha or tremendous outperformance. So many of the super investors, so this guy was definitely a super investor. He managed less than 100 clients, and therefore he could, which means he could address them in one session, and therefore he could also decide to create a portfolio where he was just doing value buying, and he was not bothered about the market. He was not bothered whether he was buying in January, selling in May, whether he was going away. Nothing mattered. He thought, if there is a good value share, it will make money for me in the long run. We will see his rules very soon. And it is worth looking at what Graham says in 1984 about this person. Walter has diversified enormously, owning well over 100 stocks, which is more than what Buffett owned. And he knows to identify securities and sell them which sell at a discount value investing, and that's all he does. I think that emphasis is mine, but yes, that's all he does. He doesn't worry whether it is when he's buying, whether it is a Monday, whether it's a Friday, it doesn't matter. If typically he says, if I can buy a $1 business for 40 cents, something good will happen, right? And even in 1980 he had not changed much. He lived in a small apartment and picked stocks more or less the same way that he had done always. And obviously at the age of 90 he was playing tennis. Longevity, taking care of health. And now let us come to what I think Buffett says are the rules with which Walter Schloss tried to beat the market. First of all, he was a pupil of Benjamin Graham and a fellow traveler with Buffett. He was obviously a value investor, and therefore the Ben Graham's intelligent investor is what he was like. Okay, let me just read out the rules. So his first rule was, Price is the most important factor in relation to value. Try to establish the value of the company. Remember that the share of a stock price represents a part of the business and not just a piece of paper. All investors tell you this. Use book value as a starting point. This may not hold today because book value has no relevance at all for companies which are growing without assets, right? So whether it is an Alphabet or whether it is Facebook or any of them, they have no assets. So that may not hold true, but we will look at it. Have patience. Stocks don't go up immediately. And I keep saying patience and experience can't be taught. You have to learn it yourself. Don't buy on tips for a quick move. Again, a simple thing which many of us keep telling you, but there is always this fun of saying, अरे उसने बोला, इसने बोला, अनिल अंबानी का शेयर अभी चलने वाला है. You will keep getting these offers. So the ability to sit tight without being influenced by all these things. Don't be afraid to be alone, but be sure to be correct in your judgment. You can't be 100% certain, but make sure that all the positive signals are there. Yes, another very important thing which people forget, buy on a scale. I mean, if you have a 5 crore portfolio, don't do a 5,000 rupee investment or even a 5 lakh rupee investment. Makes no sense. Your transaction has to be worth at least 10 lakhs, 20 lakhs, something like that for it to have an impact. So he says build on a scale and buy up on the way up. So if you bought a share at 30 rupees and you find it going up to 40 rupees, it's a great news for you. Go and buy more. So if you think that this is a 200 rupee share available at 30 rupees, it happened to us. I don't want to name the company. I bought it 30, bought it 35, bought it 55, bought it 60, and today it is quoting at about 110. What is the problem in buying up? Because you have not scaled on your first buy, so you have to scale on your way up. Similar, you may even have to sell on the scale up, or you may have to buy on the scale down. Everything is possible. So be sure that the transaction that you do is worth the time and effort that you put in. Don't be in too much of a hurry to sell, he says. And if the stock reaches a price that you think is a fair one, you can sell, but it may still go up by another 50% or 75%. So book some profit, but leave something on the table for it to go up also. So don't be all or none, right? Be aware of the level of the stock market. Are yields low and the PE ratio is high? Is the stock market at a historic high? You need to know all those things before you evaluate a particular share and how it is doing in your portfolio. When buying a stock, I find it useful to buy near the low of the past few years. A stock may go as high as 125 and then decline to 60, and you think it is attractive. Actually, before the stock sold at 20, when there is some vulnerability to it, right? Try to buy assets at a discount rather than to buy earnings. It doesn't make sense to chase earnings, but people will chase yields when the interest rates are low, and they will chase earnings when the market is high. Listen to suggestions from people you respect. This is very rare. This doesn't mean you have to accept them, but at least learn, read, understand, watch their videos, and then come to your own conclusion. Try to be as emotionless as possible while you're first time buying a share. Once it's there in your portfolio, it doesn't matter. So on the day when you're feeling good, or India has beaten Pakistan, or something like this has happened and your mood is buoyant, chances are you'll make mistakes, right? Remember the work of compounding. Compounding creates wealth. I think every investor tells you this, need not be a value investor alone. Prefer stocks over bonds, very clearly. Equity market versus debt market. Be careful of leverage, it can go against you, right? He also talks of rule of 72, how your money doubles and things like that. I think you know that, so I'm skipping that. So these are his rules, and I think these rules look good, but it doesn't mean it is easy for you to do. I will do a separate video on that, but the rules have aged well. They still hold true, and these rules could have been made in 1955 or made in 1992. I don't know, because these rules were used from 1955 to 2000. That's the only thing that I can tell you, and that's it. Thank you.